Welcome to the Capital Discussions Road Trip Trade Alerts Weekend Update with myself, Tom Nunemaker, and Dan Harvey. We normally go through a disclaimer, but just quickly, it's for educational purposes only. We're not a broker-dealer or an investment advisor, and we're not making any specific trade recommendations. And the rest of the disclaimers on the website and on the video trailer. So just remember, educational purposes only. We hope you are learning from it. So Dan and I were just talking about our trades, and before we dig into all of them, we were kind of going over the reverse Harvey idea. And let me bring up the September 16th position. So the reverse Harvey, it can be used to lock in profits, and it can also be used to reduce margin. So if you look at this trade, the September 16th, it's run up quite a bit, and you can see even with 49 days to go, the market price of these options is very close. So if you wanted to cut some risk on this trade, you could reverse Harvey, say these four, and that would cut your risk by about $2,000, and that's 19 cents times 4, so $76 to cut your risk by 2,000. And I know like Dan, you said you hadn't really talked to people about this, but this is a good technique to know about, especially as these option premiums start collapsing. Then you can really cut the margin without much effort and cost by doing this.
Well, right. And good afternoon, everybody. We usually talk about the reverse Harvey from the point of view of lifting up the right side of the expiration curve, which is, of course, a good thing to do. But as Tom mentioned, I don't know that I have spent much time in the past about using the reverse Harvey, that is to bring in a wing, which is what you're really doing. You're bringing in a wing, simply to reduce your risk and to decrease your margin requirement. And of course, if you decrease the margin requirement, you can use that money, you can use that capital to either layer something on this position or a new position. So for example, Tom's showing the 16 September, but you could certainly go back to the 19 August or one of the others, and that you might have on. Perhaps you have on a 31 August. We don't know what you have on, but you could use the same principle to free up some margin very cheaply, and it's not really costing you much money at all that you would ever be likely to get. When you get this far above the original butterfly, you're not going to get much from that butterfly that you haven't already made. So now you're concentrating on getting the expiration line above zero, and even better, getting it to where there's some profit, even if it's only 3 or 4%. So you're concentrating on that, and also to free up some margin to use to layer on a trade either in the same cycle or some other cycle.
Yeah, so it's if you think about it, when you're doing a reverse Harvey on a butterfly, let me just bring up our newest one so it's more traditional shape. You're lifting this side up, which increases the margin because you're essentially adding a put vertical spread. And then if you a credit spread, but then that pushes this down. So to pull it back up, you do a reverse Harvey on this side. So I was just showing you the reverse Harvey on just this part to raise up or to reduce the margin. But when Dan does the iron condor trades, it's really two reverse Harveys together, and the upper one is increasing the margin, the lower one is decreasing the margin. So you can think of it that way as well. Okay, so why don't we just go through all the trades now. Here is the one we're just kind of monitoring as it's starting to sink. It's it's already sunk really. We just don't want it to sink further. So we're down on this trade almost 1,000, but unfortunately this also ate part of the global protective put that added another $300 or $400 of loss to this total position. So if you go to the website and you see on the history, or the open actually is another good place to see it, this trade is down $1,400, but 340 of that is from that global put that lost money. So while this trade is actually only down by itself 975, for the accounting purposes, it's down more. But if you look at it individually, it's only down about 1,000. And a lot of good trades we make 1,000. So this is offsetting a normal good profitable trade. But we're not giving away the farm here. Like on some iron condor trades, you can give away 3, 4, 5, 6 times what you make on an average month. So keeping the losses reasonable like this is what's going to give you that good mathematical expectancy.
Well, that's right, and you can actually lose that much money on a butterfly. Let's just say, for example, that you're doing a classic butterfly wherein you put the short strike right over the market, or maybe let's just say you lean maybe just a little bit bearish, and you decide you want to make it an iron butterfly rather than an all put butterfly. And let's say the market starts to move south, and you decide, well, I'm just going to, I think it's a good trade. I think the market's going to come back. I'm just going to add another butter. And so you do, and you add it the same way, and now it looks as if you have a broad area of profitability, but guess what? The market just keeps going south. And you say, well, I'm going to add one more butter because I know this is coming back. It can't go any lower, but of course it can. And you wind up, by the time you close that out, you can lose many months of income. And when I was mentoring, I had a couple of students that actually did that, and you thought that they would make it back, and they would always, and I'm not trying to pick on them or anything, because they were students, they were learning, but unfortunately they were playing with real money. But they would always show me the expiration curve, and they would say, yeah, but Dan, if it just comes back to this area, if it stays right in here, I'm going to wind up making money. But it didn't work out that way, and rarely does.
Yep. So that's the beauty of the road trip, is we like to keep those losses under control. So when I had an optionetics seminar in Vegas years ago, George Fontenot said anytime somebody had a new trading system, the first question he asked is, how much can I lose? And that's the most important question, really.
That's the best advice at all, because anybody can put a slate, can slap a trade on. Anybody can look at the graph and say, boy, that looks really good. But the proof of the pudding is to not lose when things go bad. And if you have to lose, like we do too, the road trip trade does lose, but we don't lose much, certainly compared to other strategies. And the win rate is so high, that's what gives us the positive expectancy that we seek.
Okay, now I've got the next trade up. Now I'll zoom out a little bit so you can see the big picture on this one. Here's the expiration. So we are 1, 2, 3, 4 to 5 standard deviations away from trouble on this one. This one's really run up quite a bit. So this is the zoomed in portion right here. If we move this over, it kind of makes it easier to see. So this is in 33 days, the expiration 1 and 2 standard deviation ranges with a nice expected return of about 1,000.
Yeah, so that one's going to be good. And this is another example, anybody who wanted to take off part or all of the original butter, or to reverse Harvey some of the original butter, nothing wrong with that, to free up some margin. There's not, at least in my opinion, there's not enough time left on this one now to layer on anything else. So we're just going to be monitoring this. We'd like a modest pullback, and if we can start to move towards that upper tent, I'm going to close mine.
Well, just for the sake of argument, let's just see what it looks like if we just close the entire original butter. it would look something like this then. You can superimpose that and see it doesn't change things very much. The let's see, let me go back to both. So that's if you close the entire original butter, now your margin on this trade would be what is that, $100 or something. So you're basically cashing in that butterfly, and you still have a pretty good chance of making a little bit more. But that's if you did want to close it and cut your margin, you can certainly do that.
Right.
Or even close the whole trade if you wanted to. You could close the upper part as well. You know,
You
we
absolutely
basically made
could.
our money on this one.
Yeah, I mean, I had thought about doing one more reverse Harvey, but I don't know. What do you think, Tom? Is it even worth it now to do one
Well,
more?
possibly. I mean, there's still some premium up here, so it might be possible to lift this up a little bit
What are we
more.
looking at? Can you, because I haven't, it's been a couple of days since I looked at this. So what are we looking at in terms of that?
Well,
Let's say we wanted to be fairly aggressive. Well, okay, I'll tell you. Let's say we were going to close part or all of the original butter to free up some margin, and we were going to use that to fairly aggressively reverse Harvey this trade. What would that look like?
well, let's try something like this. That would be closing part of the original butter and make it look like this, and cut the margin down to 8,500 or so. And then after you do that, would you want to reverse Harvey maybe this one and move it down,
Yes. Uh-huh.
or would you maybe one of these strikes from the upper butter because there's more premium up here? I don't know which one you want to use.
Maybe, yeah, maybe the upper butter, because, well, of course, we want to be. We'd like to capture some of that butter if we drop back the upper butter. We'd like to capture some of that money sitting in it.
Well, if we
We
were,
try it both ways.
well, see, if we did this, this would add another $80. If we sold this upper long and bought an extra one here, and then it would look like this. So that would give us a little bit more, $80 more profit on the upside over here.
Yeah, with no additional risk. In fact, less risk.
Less risk, yeah, because now your margin is only 12.6 versus 16.
Yeah, that
So that's
might be
you
worth it.
could do
Yeah.
something like that, yeah.
Yeah.
So just some ideas. You have to play around with it, of course.
Right. And also remember that many subscribers are not going to have this exact trade. So we're
Right.
just
We're
giving
just
you ideas here. We're not recommending anything in particular because you might not have this. We're just giving you some ideas that you can do to maximally utilize your margin. Nobody likes to have dead money, certainly least of all me. Sometimes I feel in my Merrill Lynch account, I feel I have a lot of dead money. It's just kind of sitting there. It's not making anything because I can't other than a few mutual funds. I can't find anything that I consider to be really low risk. So I have a lot of dead money, but I really hate to have dead money in options.
right. Now you could do something like this too. You could just close the upper half of that upper butterfly, or do something like this, where you add a put vertical inside that butterfly. If you wanted to lift this up, it's still pretty high probability. You know, it's 1.5 standard deviations away from the current price. So it would take a pretty big move to get down here.
Yeah,
So
that actually does lift it up quite a bit.
yeah, because
And
there's more premium up here.
yeah,
So some ideas that you can do, and if you think about it, remember the vertical spread rule that I use. If I go from plus to minus, that's the direction I want the market to go. So this is a bullish vertical, and if you're doing a reverse Harvey down the other way, like say this, that's actually a bearish vertical because you're going plus to minus is going down. But what we want here in this case is to have a bullish one. So we want anything that's going to lift that to be minus on the top on a higher strike and a positive on a lower strike. So it's going from low to high like that. So really anything you embed like that is going to add on to the the potential on the upside. But I'm not necessarily recommending that. Just an example to show adding a put vertical.
That's a good way to look at it.
All right, so I think we've beaten that one to death. Let's see, how about the next one? This is our September 16th trade. This one's set up pretty well for a pullback. And let's see, that's actually, if I go T34, that's 15 days prior to expiration. Let me zoom in a little bit. And then make this axis a little easier to see. So that's where we are now. The current price is above zero, the expiration. So if you look at it on the price chart with the birdie and option view, it's going to be all green up here the higher you go. So it's an extremely wide net to catch a profit now. And very good chance if we do have any kind of pullback, this could have some really nice profit into it. So we're just kind of, hoping for that. It may or may not do that, but the risk reward is, basically no risk or small profit on the upside. And if we come back, hello, happy day, right?
Yeah, I think this one's set up pretty well. And the other nice thing about this is we have lots of time left, so I will be probably pulling some off the original butter very gradually. I'll be doing reverse Harvey very gradually, and I will probably layer something on. One thing now, when I layer something on for a position that looks like this, and Tom, you can comment on this also, but when I layer something on, I might come a little closer to the money, realizing that I have a lot of wiggle room on the downside to still make money. So, for example, if I were to layer on a new small lot butter, like a 1 or 2 lot, rather than, we'll just say, for example, using a 28 delta short strike or a 27 delta short strike, I might go to a 29 or 30 short strike. So I might get a little closer to the money to generate a little more premium, recognizing that if the market did blow through that butter, I'm in the sweet zone. I'm in the sweet spot.
Right.
So what do you do the same thing, Tom? I bet you do.
I do. I do other layering things too, like the long SPY, short SPY kind of thing to rotate the risk graph. But
right.
But that's a nice way to do it, to just keep inching this closer to the money. So when you have that pullback, I always think of it as like a rubber band effect. So wherever your T plus zero is versus the expiration line, there's a strong pull or good theta pulling it up that way. So if you can get it over here so you have strong theta, then yeah, it'll have a nice profit if it pulls back into that sweet spot.
Well, that's right. And, like I said in one of the previous videos, when I first joined the Capital Discussions here with Tom, I didn't want to talk about these sorts of things because I didn't know what our subscriber base would be like. I didn't know how many would be brand new, and I didn't want to introduce something that would totally confuse everybody. But we've been doing this now for what? I don't know, 3 months has it been? Something like that. And
Yep.
So most of our people now, I think, are pretty good traders. We do have a few people who just joined who are brand new, but brand new to trading options nearly. But most people are fairly sophisticated, I think, don't you, Tom? And so I think they can certainly incorporate these ideas into their trading.
Absolutely. We have a lot of experienced traders giving us a try and welcome. And we see lots of activity in the forums, which shows that people are really engaged and trying to figure it out and make it their own. Because to me, when I started trading options, it was more, I thought it was more of an academic exercise like an engineer. And then the longer you do it, you realize, well, you're dealing with a market with people with greed, fear, anxiety, all the emotions that go with it. So it's more of an art. So yes, there's rules and guidelines for even a road trip trade or most trades, but a lot of it's up to the trader how you actually implement it. And, you have to use your own personality, your risk tolerance, how much capital you're trading, all those different factors come into it. and that'll determine, what adjustments you're comfortable with. You might like one adjustment, and the next person that's also doing a road trip trade, he or she might like a different one or want a different variation of it or different strikes. So it's, we're showing you what we're doing, but that's just one possibility out of many. So you have to kind of learn to make it your own.
Well, that's it exactly. And what we're really trying to do is to teach everybody, how to to be able to understand how the trades work. And there's always a lot of discussion and always has been about butterfly pricing and the skews and the smile curve, and all that's important. I don't mean to minimize that at all, and certainly it does in fact affect the pricing. But I would maintain uh, that you could have a mathematical genius that knew that knew all the intricacies of the smile curve and still might not be a good trader. And conversely, you could have somebody that will say sort of understood the skew but didn't really follow it, but they were just good traders and they were able to maximally utilize their capital, move things around as they needed to, manage their risk, and they're the ones that will make money. That's what I think.
Yep, I agree. And if you're paper trading this and you haven't started doing any live trades, that's great. But you do need to, as Dan Sheridan used to say, dip your toe in the water. So don't be afraid to put on some small lots if you haven't done any live ones yet, because you do need to get a feel of how these are in live trading, not just back testing. So.
Well, that's very important, and I would recommend, maybe starting with a 4 or 5 lot, because that's enough that will allow you to make some adjustments, maybe not exactly what we're doing, but you'll get the idea and you can make the appropriate adjustment accordingly. Um, you can do this with a 1 lot, but it's really hard to make any decent money with a 1 lot. Plus, you can't make any adjustments, so you don't really learn the process.
Yeah, so one tranche, like you said, like 4 to 6 contracts is probably a good starting place. And then you can prove to yourself that yes, I can do this, I can make money with this, and then you can scale up slowly. Not all at once, but let me get this so you can see it. So yeah, don't be in a rush to, if you have a big account, to start to trade these all in giant size until you've convinced yourself that you can do it with a smaller size.
Right, and just to make sure that all the brand newbies understand, when Tom and I say 1 lot or 1 tranche, we mean like a 1 by 2 by 1. So, long 1, short 2, long 1. That's what we mean by a 1 lot or a 1 tranche.
Right. So here's our last open SPX trade, the September 30th expiration. And like I put on the slide the other day, the little toddler, this trade is still pretty early on. So I don't know if you saw that or not, Dan.
Yeah, I did. Yeah.
Picture.
Yeah. He's still looking at his fingers.
Yeah, this one's pretty young still. So
yeah.
As far as like the next one, I think we're seeing this. Where is it? The library? No, it's the. I can't remember where I have. Oh, it's on the calendar. We're in our window for the 14 October expiration. What are your plans? Is that's the next cycle you're going to put on, Dan?
I'm either going to do the 14 or the 21. I may do the 14. So that's a regular weekly, right?
That's a weekly, and
yeah, the 21 is a monthly.
Yeah, this would be 2 weeks after the September 30th, and then that 2 weeks after that would still be in October. So this seems like the natural that those two would be our target entries for October for SPX.
Yeah, I will probably look at the October 14th then instead of the 21st.
Yeah,
so that's a good.
And then
that's a good
obviously
point.
for Russell, we're going to wait until the second was our window opens for the Russell, but I think SPX we should probably get going on the 14th of October.
I would agree.
Okay,
so that'll be next week.
Yeah, that's our target entry week. And just before we go on this one, if you're new and you see it's down, don't worry about that because, look at the total risk is so small, it's under 5%, that this is very easy to raise up with reverse Harveys as time goes on. But, if you look at the target exit date of 15 days before expiration, that would be T48. So that's 2 standard deviations of movement for that would put it all the way down here, which is why we don't want to reverse Harvey too early because there's still so much time, 63 days to go, that the market could meander down this way, and we don't want these T+0 lines sagging too much too early. So don't be concerned if you're underwater on these new trades, especially if they've gone up like this, because they are slightly negative delta. But we know that, and we're going to raise this up if it stays up in this area. So that's just part of the way it's traded.
Well, that's exactly right. I mean, this is just a part of the road trip trade style, and after doing this a while, you don't even think about that because you're going to get that line up, and you know that you're probably going to layer something on top of it. You just want to be fairly gradual because remember, and we've mentioned this before, when you do a reverse Harvey for a credit, you're not really making any money. You're just raising up that right line, but there's a trade-off. You are giving up the opportunity to make a little bit more than you would have made on pullback, and this is why we do it gradually. Because as Tom mentioned, we don't want that T+0 curve to be sloping down too much, and we also don't want to give up the opportunity to make some pretty good money on a pullback. So we do the reverse Harveys very gradually, and we layer on very gradually.
And the other thing to notice, if you're worried about that we're underwater on this trade, is that we're underwater $100, and we have 28 theta. So in 3 to 4 days, theta alone, if it just sits here, it should bring it back up to break even. So it's nothing to worry about that it's underwater at this point.
And that's the reason why Tom and I have the 5% rule on launching these things. You don't want to start out too far underwater because then it is more difficult to make that up. And I just would remind everybody last week, right at the end of our monthly Q&A video, I showed the parameters that I use, and they're not, set in stone, but I think they're very good guidelines for exactly the parameters for what constitutes a good starting butter. And one of the parameters was to not have more than a 5%, maybe 6%, but I like the 5% of the right side of the expiration curve being underwater when you launch the trade. Because if it's much more than that, it becomes a little more difficult to lift that up above zero.
Yeah, and because this is so close to zero, it can wander quite a bit above the tent, and you're not really concerned about it. But if this was down farther, now instead of being down 100, maybe you're down 500 or 600 or 700, and now you're going to have to work a lot harder to get that line back up.
So then it becomes more like a sea of death as opposed to, just a little bit underwater.
Yeah, we're just in the wading pool right here. So.
Yeah, we're in the wading pool as opposed to the sea of death. Exactly. Good one, Tom.
Right. All right. So let me pull up the 2 Russell trades we've got. And let's see. This is the probability. I already did that one. Probability touch. And again, this is one of those ones I have to zoom out a bit because we're so far away. Okay, so this one is underwater 1400, but in contrast to the SPX August 19th that is being penalized for the global put, this one is actually benefiting because the global put on this one actually made money. So if we go to the class page to the open positions, you'll see that this is down 863, but it's getting a $580 lift from its portion of that global put that actually made almost $1,200. But that being said, here we are with 21 days to go. Here's 2 standard deviations, so I'm just using my fingers three. It's almost 4 standard deviations to get down here, which is why you're seeing all these probabilities of touching the short strike at 0, and probability of profit at 0, because option view knows that there's very, very little chance it's going to get down here. So at this point, all we're doing is just monitoring for an iceberg, the Titanic, the big move in the market. But barring that, it's just going to go out worthless, and we'll eat the loss and move on.
That's right. But you could free up some margin if you needed it with this trade.
Yeah, you definitely could. And you could do the reverse Harveys like we talked about. So if you did this with 8 of them, that's 5 cents. So that would cost you $40 to do. And what does it do to the margin? It cuts the margin from 9,000 down to 2,000. So for $40, you can cut the margin down quite a bit. So
that is very.
Something you. Yeah, go ahead.
Well, I was just going to say, yeah, I'm sorry I interrupted you. I was just going to say that is very important. I mean, this is a skill, a technique that is absolutely critical to understand the way this works, because now that we've begun actively layering things on top of existing trades, we will from time to time need to utilize whatever margin that we started with, and keep that money working. That's what we want to do, as opposed to dead money.
And here's a visual overlaying the current trade in blue with that reverse Harveyed version, and you can see how dramatic that cut in margin is. And it really doesn't change this very much, by $40. So,
yeah, that's really amazing for $40 that you can do that.
Well, 5 cents. 5 cent spreads do that, right?
Yeah, and a lot of people never think of this, but that's important to learn.
Okay, so that's that one. And our other open August position looks like this. And here's expiration. So we're 49 days out. Let me see if I can make this a little taller so you can see it better. So you can see the exit, or the P&L above 0, above the tent is pretty nice. And if we go, I guess it's set for 15 days already. So this line is our 15 days before expiration. So option view is giving us 100% probability profit because it's outside of 2 standard deviations quite a bit. So this one looks like it's going to be fine. What are your thoughts on more layering, or do you want to just see if it's going to pull back in here, reverse Harveys?
Yeah, I think I would like to maybe start with just the reverse Harvey on this, and maybe free up some of the margin from the original butter by taking a little bit off. But if we keep moving higher, my plan is to layer on more after freeing up margin, because we have enough time left that we can get some good theta out of this.
Oh, yeah.
What
Almost
do you think?
50 days. Yeah, there's 49 days to go, so you can see there's lots of time premium. If I switch this to time premium, you can see there's lots of premium in these options still. So, just rolling this up is 24 cents, so this would cost you $72 to reverse Harvey these. And that changes your margin. It drops it down 3,000, which makes sense. It's 10 strikes for a 3 lot. So it's $3,000 a margin. Yeah, for $70.
Which is plenty enough margin to layer on another butter, for example, or another unbalanced condor. So again, we're just keeping the money working for us.
Yeah, so there's your freeing up margin, and you do another layered trade and keep the margin about the same, but give yourself a chance to make more money up near the at the money price.
Yeah.
Okay, so that's it for our open trades. I just want to bring up my trade on the SPX that I use those SPY, just to show people that again. This is just, I went flat before Brexit, and then after Brexit, I got back in with a September. There's actually 2 September trades on, and I'll just leave it so you can see it like that. So I added, I'm long 100 SPY on this. Now, if I didn't have the SPY, it would look like this. So fairly flat, but I'm still bullish on the market, so I wanted that lift on the upside. And if you compare these two, you'll see it essentially just rotates the whole risk graph. So it's rotating it counterclockwise, maybe a couple of degrees, and it pushes this down and pushes that up. And there's a lot of profit over here, so I felt that it wasn't too bad of a choice to make that rotation. I'm not too worried about a big down move. Again, I'm kind of bullish on the market, but even if we do have a little bit of a down move, there's still lots of room for this thing to make money. And the more negative deltas or positive deltas you rotate it more to the counterclockwise, so that would be another 10 delta. And the one thing I like about SPY is I can be very granular. So say I didn't have anything on and I look at this and I'm plus 6 delta. If I wanted to go flat, that would just sell, say, another 6, so it goes 16. And then I would be net short 60 SPY shares or 6 delta, and that would completely flatten out this T plus 0 line. So you can just by rotating the risk graph left or clockwise or counterclockwise by buying or selling a few shares of SPY, it gives you some flexibility that you might not have thought of before. And my wife likes this risk graph, so if she's happy, I'm happy. So.
You bet. Well, yeah, this is a good looking trade, and as we've talked about before, SPY is extremely liquid. If you didn't want to do 100 shares long, just do 50 if you want to. And I would say, well, first of all, I won't be doing this in the class trades because many of our subscribers, have limited margin. So I always try to keep, within reasonable margin limits and parameters. This works really well in a PM account. You can't short SPY in a Reg T account. So, for all those reasons, I won't, be doing this for the class account. But this is a wonderful thing, to learn for the more advanced traders or even intermediate traders that are well capitalized. And personally, I like this better than using futures. Now, I mean, I like to trade futures, but I don't like to leave them on overnight. You're a lot safer leaving the spiders on, overnight. You probably don't have to worry about that too much. And they're so flexible and so liquid. You can get in, you can get out. If you're really worried about a big downside, a down move, go ahead and set up a stop order to close out your SPYs. There's just lots of stuff you can do with the SPY.
And this is in a PM account, and the margin, the Reg T margin looks like 57, but my PM margin at IB is about 19,000 for this trade.
Yeah.
And then I think when I put the SPY on, the margin increased about $800, so it wasn't a really big deal to do that. But yeah, it's a nice technique, and like you said, the SPY is so liquid. I'll also use it sometimes if I'm trying to close a position, and say I'm trying to close a butterfly, and they won't fill the whole butterfly. I'll try and do the individual verticals, so like -2 +2 or -2 +2 there. And if one of them gets filled before the other, if my deltas are too out of whack, I'll just buy or sell some SPY to hedge myself off to get just get the delta neutral until the other half fills, and then I'll take the SPY off. So that's another way to keep yourself from having a lot of market risk while you're closing a trade. Just use the SPY to hedge off your deltas.
That's right, and they will fill this within a penny or two. And for the Russell, you could use the IWM. It may not be quite as liquid, but it works pretty well. So you could do the same thing with using IWM for Russell. I don't know if you do that, Tom.
Well, I don't. I just stick to SPX, so I just use SPY and SPX. But I'll do market orders and SPX, and bam, it's filled, and it's so fast.
Yeah.
So you don't have to worry about that. But I just wanted to show people because I've been posting this in the forum, and if you want to talk about it, this is the trade, and if you like it, great. It's just another layered position, really. If it didn't have this, I could do some kind of option thing or futures, but just longer shorts and SPY is another layer version, instead of a butterfly or condor or vertical spread. So with that, anything else you want to go over, Dan, or is that it?
No, I think we covered just about everything. So for next week, I will be putting the daily planner notes on, uh, probably tomorrow, Sunday, Sunday my time, and so you'll have them available to look at. So I'll get them on, and next week I will try to pick a good day to launch the SPX 14 October, and I may do for the September 16th, may do some layering and freeing up margins. So be ready for that for next week.
And next week, it looks like we'll also be in the window for the 21 for the monthly expiration. So I would imagine you'll also start looking for the October Russell entry as well next week.
Right. Yes. Yep.
All right. So thanks everyone for following us, and we'll look forward to talking to you in the forums and on the Q&A. The next one's on Saturday, August 13th. So in a couple of weeks. So we like doing those Q&As. It's a nice chance to interface with you. But with that, have a great weekend and enjoy trading next week with the road trip.
Right. Thanks a lot, everybody.